as we've heard from the big banks, we're starting to get results from the smaller regional banks. Today, we had First Horizon, the Tennessee-based regional bank that missed numbers and cut its full-year net interest income forecast. That was because of increased competition for deposits in what is the hottest region in the country. And that's why the stock dropped nearly 6% today. First Horizon usually tends to be a steady operator, which is why its stock is still up 16% for the year. Think about that, even after today's pullback. So how concerned should we be about this new competition? Let's check in with Bryan Jordan. He's the chairman and CEO of First Horizon to get a better read on the quarter. Mr. Jordan, welcome back to Mad Money.
Thank you. Thank you for having me.
Okay, so Bryan, when I moved to New York in 1980, I opened an account at a bank, and they gave me a toaster because they wanted my money so badly. Are they giving toasters down there? Is that what's happening?
No, not toasters yet, but it's pretty darn close. We're seeing a tremendous amount of competition. It tends to be very aggressive for money market and CD deposit rates. We see a lot of specials in the marketplace. And what we experienced this quarter was a little bit of a shift in what we'd seen in previous quarters. We had about $1.5 billion that was at what we would consider back book or base rates that essentially repriced in defense of offers. So we were very cautious about not protecting our customer base. We wanted to ensure that we protected our customer relationships, our client relationships. And so we matched offers, and that raised the price of deposits overall. So if you looked at the first part of the quarter, I'm sorry, that we saw our interest rates on deposits actually dropped April and May, and it started to accelerate with this competition in the June timeframe.
But how do you combat that? I mean, look, you're a solid bank. You're a good operator. You guys got coming in there, I guess, because you were in the hottest area of the country. I guess banks that don't have a lot of growth are coming in trying to pick up business.
They're tremendous growth markets, and in the aggregate data, you see that the deposit base continued to shrink on a national basis. It's a function of the Fed continuing to shrink its balance sheet, and our customer base is very strong. It's in great markets. There's a lot of competition coming into those marketplaces, and it drove a little bit of increase in cost. We are going to defend our customer base, and we think about it in the long term, not from a quarter-to-quarter basis.
Oh, but let's talk about the loan business. I mean, if you're in a great area, obviously there's still a lot of there's loaning to be doing. I read through this part. People seem to be worried about your commercial real estate. I mean, the 60% loan to value, they're not tall buildings where I'm worried about. I mean, basically, it seems like all the worries that people have are not being justified.
Yeah, I think. Look, commercial real estate is one of those things that is going through a bit of a down cycle, but it's not something that keeps me awake at night. As you said, our commercial real estate portfolio is very diverse. Half of our office portfolio is medical office, which tends to be 100% fully absorbed. When we look at our office portfolio, as you said, we tend to loan to 9-story buildings or less. I think we have 8 loans on buildings that are greater than 10 stories. It's geographically diverse across the footprint. Great borrowers, great borrower relationship, and very strong loan to values. So commercial real estate is under a bit of pressure. It gets a lot of coverage, but it's not something that keeps me awake at night.
Okay.
Not today.
Okay, so tell me about what happens. What's the denouement here? Do some of the banks realize, you know what, we're not going to pick up business? Or do we just stay in a dogfight for a long time and you can't give us the return that we want?
I think it's going to be an interesting environment, at least for the remainder of this year. And I think you've got the convergence of two major things. One is reasonably obvious with the presidential election coming up and what that means in terms of regulation, taxation, competition in the economy. There's likely to be a different outcome depending on who wins the White House and Congress. And then the second is the Fed going to cut rates later this year? When and by how much? And I think when those two questions get resolved, the economy ought to start to accelerate. Loan demand ought to pick up a little bit. And I think it is going to be a bit of a dogfight, as you suggest, for the remainder of this year. But I do think we see optimistic reasons to feel good about 25 and beyond.
All right. Now, we have a lot of people who watch the show who have mobility that move into Tennessee, Florida, and Texas. OK, if you wanted to be savvy Is it time to maybe ring the register in Nashville and go over to Memphis?
Well, it's an interesting question. I think we've had great momentum in Nashville, for example, in Tennessee for the last couple of decades, and it continues to grow very aggressively. We have a lot of things that are going on that are very attractive in Nashville. In Memphis. We're seeing XAI come here and build a facility here. We're seeing a lot of positive reasons for Memphis to accelerate. And I think that's true of a lot of the base cities we have around our footprint, whether it's a Birmingham, a Huntsville. We think we have a great footprint with a lot of opportunity for in-migration and strong economic growth.
Now, do you want to expand beyond that footprint, or is there still, because I don't want you to be in a dogfight for the next 2-3 years. Are there places that you can, that these out-of-towners don't understand, that you could go make a big hit in?
Well, I think we have the opportunity to continue to invest in this 12-state footprint that we have. We are undersized in a number of these markets, and we can continue to be very aggressive and competitive in those and continue to invest in places, like I mentioned, Memphis being one, but you've got Houston, Dallas, and Texas. You've got the entire state of Florida, essentially. You've got Atlanta, Georgia. You've got the Carolinas, the I-85 corridor from Charlotte up towards Raleigh, Durham, Chapel Hill with the Triad in the middle. We see a tremendous amount of opportunity to invest in this footprint, and I don't think we need to expand it.
Good. I don't want you to. You're in the best area of the country. You don't need to go down market. Well, I want to thank you, Bryan. You're always a straight shooter. Bryan Jordan, Chairman, President, CEO of First Horizon. Love having you on the show. Thank you.
Thank you.
Okay. Mad Money back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.